Well, let's turn our attention back to those big expectations for big banks. Average quarterly earnings expected to double year on year, at least according to some estimates. Let's bring in Gerard Cassidy. He's RBC Capital Markets analyst. Gerard, the bar is certainly high. I mean, it sort of feels like we're going to be saying that a lot throughout the earnings season, but you've got the dividends back after the stress test. We've seen the big banks outperforming financials broadly. How do you think things look going into tomorrow?
I think the outlook for the banks in the second quarter is very positive. And the reason being, and you already highlighted, the earnings comparisons to last year's second quarter are going to be quite significant. And we're expecting earnings on average for the largest banks to increase over 100%. And the primary driver for this earnings growth is what we refer to as loan loss reserve releasing. You might recall in the first and second quarters of 2020, at the start and at the height of the pandemic, the banks set aside billions of dollars for credit losses. Well, those credit losses never materialized to the level that the banks had expected because of the success that the federal government did with its fiscal program, with the stimulus payments, and also the Federal Reserve's actions in bringing the economy back much faster and stronger than anybody imagined back in July of 2020. So now the banks have all this money set aside for losses that they're not going to use. So now they're bringing it back into earnings. Now, granted, not many investors will pay up for these earnings because they're one-time in nature, but it's important to remember that these earnings go into capital and book value. And the industry is overcapitalized. You pointed out about the dividends and the stress test. It was very clear they all passed the stress test. They all many, if not all, raised their dividends. They all have very sizable buyback programs underway. So we think the outlook for the second quarter and the remainder of the year is quite positive for the banks.
I mean, Gerard, to your point, the headline number is expected to be quite impressive given the big bump that the banks are likely to get from those loan loss reserves. But how do you think investors should be looking at sort of more the mechanics of it? Like what specifically are you going to be looking for beyond that headline number to see whether, in fact, this type of momentum can continue once we get past this quarter?
I think what we're going to do, and many investors will do this, we all anticipate that the rate of change in earnings per share will decline as we go into the third and fourth quarters of this year and then into 22 on a year-over-year basis because the comparisons to last year are quite easy. So when we look through the numbers, after you see the headline number, there's going to be a couple of areas of focus for investors. First, I think investors will take a look at the net interest revenue growth. That's the revenue generated from their assets less funding costs. And so this is driven by loan growth. So I think you're going to find a great deal of focus on loan growth because it's been very tepid year to date. In fact, it's been down. The area that we have seen some loan growth so far has been in the consumer area, but corporate and commercial loan growth hasn't really materialized yet, and it continues to shrink. And that's a very large component of total loans for the banking industry. Second, we're also going to take a look at the capital markets activities for the banks that are in that business. Those are the big banks, of course, the JP Morgan Chase, Bank America, Citigroup, and of course, Goldman Sachs and Morgan Stanley. And it's going to be interesting because expectations are low that the numbers here in trading and investment banking are going to be weak relative to second quarter last year, but also relative to first quarter of 21. And then finally, we'll continue to have a focus on the share repurchase programs. Now that there's no restrictions on the share repurchase programs, other than the fact that a bank is not permitted to enact a capital action program that brings their CET1 ratio, Common Equity Tier 1 ratio, below the regulatory minimum. So I think you're going to see some discussion on the earnings call from investors with management teams. How aggressive will you be on your share repurchase program? Because these programs are quite sizable.
Gerard, in terms of the issue of loan growth, which one of these big banks do you think are likely to show the most strength? What are you going to be watching?
It's a good question because where we're seeing the loan growth materialize already is in the consumer area. And so when we look at the big banks, that's of course JP Morgan Chase, Bank America, Citigroup. All of these banks have very formidable consumer banking businesses, in particular JP Morgan and Bank America. Citi's is more of a global footprint, so their U.S. operations do not compare as favorably as to Bank America and JP Morgan. Wells Fargo is a bank that still has a restriction, the asset cap, that came from a cease and desist order that was issued in the early part of 2018. So their growth has been hindered this entire period due to this asset cap. So any evidence or any discussion of when that asset cap could be lifted will certainly be very important for investors in reviewing the Wells Fargo's results.
We'll be watching closely when the first results come in tomorrow. Gerard, Cassidy, RBC Capital Markets analyst. Good to talk to you today.